This is us. Good, 20146, your SMS line. Okay, just before we go to Paul and Joanne this morning, let's again take a look at a Family Bank's key performance indicators as well and their profitability trend, which, as you're going to say, as one of the banks that since last year have really known how to navigate through what have been the thicks of the coronavirus pandemic. That's exactly what we're talking about. Their profitability trend standing at 1.1 billion within this tough coronavirus environment as well. Now, Paul, how would you analyze a Family Bank's profitability trend within the coronavirus pandemic?
Okay, Family Bank has actually, in my view, taken to addressing the problems of the lower segment of the market,
Yes.
just like Equity Bank has done. So you find that most of their revenues come from transactional incomes. So you find also that Family Bank has done a very good job in maintaining their books,
Yes.
their loan book, to the point that the increase is very little. And as it was said, that they've been taking provisions over the years such that they didn't have to take so much this year. So Family Bank is something that we should all emulate. The second thing which I want to point out was how banks will operate.
Yes.
At the end of the day, it's only banks which have a larger proportion of variable costs
Yes.
compared to fixed costs that will survive this market. These results are going to force all the companies in the economy, including banks, to change the way they operate. Organizations must move to variable costs. You find that hotels and other organizations which have very high fixed costs, Kenya
Yes.
Airways, those organizations are going to have lots of problems as we go forward.
Yes.
Any organization which is borrowing and has high fixed costs will have lots of problems. So, as long as the organizations that are in this economy change and change to models which promote variable costs, be very lean, sell off a lot of your assets which you don't need, and move to variable costs. That's the only way that long-term sustainability can come in. And I think some of these banks have done that. We've seen KCB, we've seen Equity, and most likely Family Bank
Yes.
moving to points where they are. A case in point is Equity. For the last several years, their staff costs have actually been reducing, but this year I think it went up, but possibly due to the acquisition of the Congo Bank. But you find that the staff costs of many banks has been stable or reducing. So for most banks, for them to survive in the coming year, you must watch your loan book and you must change the way you operate. And it's the same with almost all organizations in this industry.
Yes.
They must operate in models where variable costs rule, so that when there's no, if you don't have customers, your costs are also low. If you have a lot of customers, then your costs can be high. So that's my take on how Family Bank has been and how we go into 2021 going forward.
Pretty much, Joe, and clear for us that conversation on what was a glimmer of hope in the results that we've seen so far. Family Bank, how would you also synthesize for us that performance for that bank before we talk about another one, National Bank of Kenya?
I second Nganga in terms of Family Bank
Yes.
being able to just capture the lower the market,
Yes.
just being able to work with that, and being able to work with that group of people, which is a large, a huge fraction of our economy. They have done well in maintaining that. I also noticed that some time back they also started working with people in the diaspora. So I also think that has really helped them in terms of maintaining their liquidity in terms
Yes.
of remittances from the diaspora. So that has really also, I think, built their portfolio and helped them in terms of maintaining their position. I also think that in terms of being consistent, Family Bank is an old bank, so they have been consistent in how they have done their operations, how they have maintained their costs. So we are looking at people who have been consistent over the years, being able just to maintain their status quo and being able to, in fact, generate a profit, as opposed to having a reduction in their. It's an issue of consistency, an issue of understanding your market, and also an issue of products that support your bottom line, and
Yes.
just being creative in who you're looking to target. And for me, uh, we shouldn't look at it as all gloom and doom in terms of 2021. We have had uh, done previously, so we have can borrow from experiences of last year in terms of how to operate business, to get the economy running for the government. So let's not say that bad. Let's say that we have had a lockdown last year, and we can borrow from experiences and things that are positively to sail us through the lockdown that we are currently experiencing, and when we will see ourselves out of the COVID situation. So I think let's go done best practice from last year, and see how that can help us survive in the coming days, to when we can see ourselves out of the third wave and into out of the corona entirely.
Pretty much. All right. Just quickly, and that Abraham, I'm coming to you in the studio so that we take 2 minutes, if you may, so because we have a lot to go through this morning. And Arnold, get ready to also take call National Bank as well. All right, Richie, can you give us exactly what were the key performance indicators for National Bank? Because they're also talking about a good story as well, and that's exactly what we're talking about. If you look at what the key performance indicators have been, really, you can actually see how the total interest income really jumped again for the entire of 2020, which led to that profit after tax that we're talking about them. And if you look at their profit trend, because that's where now you can actually talk about where they are, they came down from 336 million to record 177 million in terms of their profitability. But Abraham, even as we speak about this, we do know that they still have capital adequacy issues. If we factor that in, are we still going to say that National Bank of Kenya became profitable?
You see, profit is calculated in a certain way.
Yes.
So if they've showed profit, then they have profit. But, and remember,
Yes.
they were acquired 100% by KCB.
Yes.
And KCB has put a lot of capital into them. So if you look at, it's a question of how did they deploy that capital.
Yes.
So most of that capital has probably not been lent out, but probably has gone into government securities. And you can see the income. So you need to break that down.
Yes.
But give it to them. And don't forget the year when they went into losses, they took a very big hit
Yes.
on provisions.
Yes.
So again, like Family Bank, they took their pain a bit earlier than all of us. So for them, don't forget they're part of, actually, their results are normally consolidated within KCB.
Yes.
And but as a standalone subsidiary, they've done well. If
Yes.
you look at that metric of profitability,
Yes.
the issue, if you want to go about the issues of liquidity or adequacy, that's a discussion for another day.
Yes.
But I think now with the kind of capital they put in, those ratios are now being met. So I think the theme here is plain and simple. I think it's better to take pain in smaller doses than take it in one big.
Yes,
Yeah.
pretty much. And old, let's come in at that. I remember we spoke about National Bank with it, was it last week? So can you talk to me about how you can actually also look at that result? Do you share the same sentiment with Abraham that, well, it's profit if it's profit? Don't look at other issues that may have been having about capital adequacy.
Yeah, I think what they did, two things. They increased their asset base.
Yes.
And they also managed their cost, because they reduced their cost by about 6%.
Yes.
So for them, they sort of found a way to balance their asset base in terms of increasing interest income with some of the loans, which by growing their loans, quality loans.
Yes.
And then they reduced on the cost of business.
Yes.
So generally, that is how National Bank, made a profit as far as 2020 is concerned.
Pretty much. Paul, let's talk about the next part of our conversation this morning. And it has been big again, and I remember I spoke to you about this. Now, let's delve into that. Just before we do that, let's look at Equity, which was one of those big banks again, that despite going through an 11% profitability dip, their profits were 20 billion. Good. Let's look at the balance sheet this morning so we can talk about it. Which, if you could jump to Equity Bank so we can talk about it this morning in terms of their total assets. Again, 1 trillion, but there's a conversation point there, which is exactly what I'm going to ask you about: the cancellation of the dividend, which makes their assets actually now cross the 1 trillion mark, the biggest one we've seen this year again. All right, let's look at the profitability trend. Richie, if you can jump into the profitability trend again for Equity, all the way from 2018 up to where we are right now, because we know they stand at 20 billion now. Good. Do you have it? Richie, can you confirm? Fantastic. That's where they are in terms of that profitability trend. But then again, Paul, they cancelled the dividend. Let's go to another bank that also cancelled the dividend, APSA. All right, let's talk about it this morning in terms of the profitability trend and key performance indicators. Again, this morning, that's where they are. They said that profit of 4 billion was not enough for them to pay their dividend, so they cancelled that. Fantastic. Paul, to pay or not to pay? Because you have 20 billion, you didn't pay even a shilling. What are we looking at?
Yeah, thank you, Elijah.
Yes.
I think when Equity Bank released the results, I think their CEO, Dr. James Mwangi, mentioned that this is not a year for growth or profitability. He mentioned that this is a year for them to stand with their customers.
Yes.
I think I caught that from the release of the results. So Dr. Mwangi emphasized that they want to stand with their customers.
Yes.
Now, it's been a difficult year. You've seen that the number of people registered negatively in CRB went up from 9 million to 14 million this year. In the 6 months to January. 14 million people registered negatively on CRB.
Yes.
Means that people are definitely having lots of problems. This time, you find that a third wave has come in. We've not heard of any measures that are going to be taken to reduce the burden to the people in Kenya.
Yes.
So 2021 is also going to be a difficult year for most of the borrowers in Equity Bank and any other bank. So it was very prudent for Equity to cancel their dividend. Yeah, it was very prudent of them to do that because they know that if they need to take another 20 billion additional provisions next year, they'll not have a problem doing it. Some of the other banks will have a problem taking this type of provisions next year.
Yes.
They will have problems with central bank in terms of capital adequacy. But a bank which is conserving its liquidity will survive that much better. You've seen some banks have actually issued I think a bonus. I don't know whether it was INM or some bank like that, who are issuing bonus. It's better to issue a bonus and conserve your liquidity rather than give out the liquidity you have and then next year come back and ask for liquidity. So I think it's been a very conservative approach that they have held.
Yes.
And for the longest time, Equity has always given a constant bonus, a constant dividend of I think 2 shillings per share for the longest time.
Yes.
They have always given it. But for the last 2 years, I think the shareholders have really stood with the group CEO when he convinced them to actually forgo the dividend. So he must have a very very good way of convincing his shareholders, because shareholders sometimes can cause lots of troubles when they miss dividends, especially for 2 years.
Yes, Paul. All right.
Yeah. So
Paul, let me bring in Abraham in on as well on this. Abraham, you're gonna make me understand, and this is the only way you're gonna make me understand as well. Good. Richie, can you jump to KCB performance indicators for this year as well, so that we can see who was really supposed to pay and who was not supposed to pay? Because then when we talk about these two banks, they seem to have sort of a similar strategy: offshore investments, regional investments, and if you look at where they are in terms of lending, then you can actually say that they're close together. Good. That's where KCB are. They ended profit after tax 19 billion. Abraham, that's good. All right. Richie, can you jump to Cooperative Bank this morning? So we'll also look at where they were at the end of the year in terms of their profitability. Again, you're going to say that that is Cooperative Bank. Could you jump over to Cooperative Bank, Richie, so we can actually look at it as well? Because that's where the conversation point comes. If you have it, indicate to me. Good. You're going to say, Abraham, that KCB, Cooperative Bank, and Equity, that's where they are. No, we're looking for Cooperative Bank, Richie, if you can. You're going to say that in terms of that profitability trend, they're quite close. They're quite close because those are the three big boys we do know in the country. How do we justify 19 billion and 20 billion and a cancellation for 2 straight years for Equity when they're making profits that are quite high within the economy? When the conversation was, can you at least pay something? Because we do know that even your investors, they're affected by the COVID-19 pandemic. So if you pay something out of your dividend, it also goes a long way in helping them as well.
See, the first thing we have to distinguish.
Yes.
There's a difference between profit and cash.
Yes.
Now, look at this profit. What is driving this profit? This profit mostly is from interest income.
Yes.
This interest income has come from loans that have been on a moratorium for 9 months.
Yes.
So it means, if you look at, the accounting is done based on accrual.
Yes.
So that income has accrued, but by the time the year was closing, had not been received.
Yes.
Because the moratorium ended in March this year.
Yes.
So they still had 3 more months. So you'll find, let's say, a loan that for 1 million, for argument's sake, 1 million shillings, it accrued interest for 9 months.
Yes.
If it was doing 12%, that means it did loans at 9%. So a full 9% of that 1 million shillings had accrued. So it's showing under profit. But in terms of a single shilling that bank receiving on that particular loan of 1 million, they have not received it.
Yes.
Now, accumulate that, and now they show it as a profit of 19 billion. Now, if they are to pay dividends, they pay it out of what? Cash. So if we really want to analyze this, then what we need to put up, or we need to do maybe another session,
Yes.
is look at how does their source of funds and application of funds, how does their cash flow statements look like?
Yes.
And most likely you'll find they were tight. And if they had hit, if they put in a dividend in,
Yes.
probably it would have stretched it.
Yes.
So I agree with my colleague that this is not a year of payout. This is the year of conservation. Because yes, you will pay out and probably you'll be coming back next year for a cash call.
Yes.
So the illusion is that profit is cash.
Yes.
That's what I'm trying to demystify. Those are two separate issues. And especially in this case, we know how that profit has been built. It has been built on the assumption that CBK has told us to wait, so we've charged you interest for 1 year, but you did not pay us. So you're paying us in March. So come March, whether or not, so now it will show interest for a whole year. So if it's not paid, then again you go back to your capital line and take a hit. Now, if you pay dividends and then take a provision, you see, those are the kind of things that big banks are trying to go through.
Yes.
So, yes, the investor also doesn't want to know. They also want a return on there. So and that's why you see COP probably bulged on their on the weight of their shareholders. Yes. Equity and KCB were able to convince theirs.
Yes.
But the fundamentals are the same. That this profit has been built out of delayed cash because it is on accrual as per CBK guidelines.
Pretty much. All right, John. We saw some headlines again when we were looking at what the key performance indicators for the two banks now. We do know that banks are struggling to take that top spot within the country. All right, let's cross over and look at what are the key performance indicators for KCB again. And we're actually looking at what are their total liabilities and assets now as we end the year in December 2020. If you look at that as well, you will see that that is where they actually stand. I'm talking about KCB, Richie. If you can actually jump to KCB, good. That's where they are in terms of, can you jump to what are the key performance indicators in terms of liabilities and assets? Good, that's where they are. Equity, you'll see under the key liabilities and assets, they are at around 1 trillion. But now, Joanne, we saw this headline in terms of what are the biggest banks in the country right now. Was it a wrong headline for you to say that Equity now is the most profitable bank in 2020, going by the fact that this is a bank that has cancelled their dividend payout for 2 years now?
Well, I personally didn't put it that way.
Yes.
When I look at assets versus liabilities, T and I see that the ones for liabilities for equity are pretty much almost at the same level in terms of higher and difference between asset and liability for equity margin and for KCB pretty much the margin is higher in terms of ability to pay your liabilities as and assets. So for me, I don't look at it from a perspective in terms of it being the biggest bank. I look at it in terms of or liabilities versus assets. Are you able to make payment for your liabilities as and when they are due? So for me, I'm looking at assets liabilities for equity, and I can understand why they cancel their dividend. Their cover for liabilities against the assets the margin is very small, so I understand why they cancel their dividends. I would not look at it from a particular profitability, but in terms of ability to cover liabilities for your assets and in terms of your cash flow. So for me, that's the angle that I look at it from, the two banks in my perspective.
Yes, and I'll clear this conversation for dividend payout, equity versus the two big boys, KCB and Cooperative Bank, who paid a shilling. How did you interpret that and compare that with equity now? For 2 years running now, we are not going to see a dividend payout. Should have they paid, or it's fine, like Paul and Abraham are saying, it's a wait and see period for the banks in the industry?
Yeah, I think it's a wait and see period for the banking industry, simply because two things. KCB restructured loans to a tune of 106 billion.
Yes.
Equity restructured loans to a tune of 171 billion. So equity essentially restructured more
Yes.
than what KCB restructured. And then both banks have gone out and made acquisitions, so that has an inherent cost list to it. I think equity's move was prudent based on their position. I think they restructured more than KCB. So then the feeling was, with the restructured loans, it's a 50-50. You don't know if you'll have a recovery on the same.
Yes.
You may have to continue with restructuring, or some of them may actually go into a loss position. So for equity, I feel that they made the right call in not paying out the dividend. And I think, as Abraham has mentioned, I think the group CEO has support from the shareholders, because everything seems to be calm. I think for KCB, they felt that they could take a hit. If you look at the differential in terms of both banks, in terms of what they made as provisions, my take, I feel that KCB felt they had a leeway to pay dividend, albeit a lower dividend than what they had previously paid in previous years.
Yes.
So I think both banks navigated things differently. One restructured more than the other, and I feel that is part of what made the differential in terms of either to pay or not to pay the dividends.
Pretty much. Abraham, once we come back, we're still on the big boys. Regional investment, cooperative, KCB, equity. How have they fared on? And if indeed these regional investments are going to be looked at in 2021, and what impact they're going to have in their final results come 2021. You're still watching A Business I Am. This is Metropole Television. We're looking at the performance of the banking industry in a 2021, a year that was described by two words: profitability dip and loan loss provisions. Once we come back, how have the three boys performed in terms of their regional investment here on Metropole Television?